Welcome to the Daily Drawdown, where NVIDIA's numbers meet the real limits of the AI build-out. NVIDIA can sell nearly every chip it can make. The larger question is whether power grids, financing structures, and customer economics can support the next leg of demand. NVIDIA delivered roughly $96.2 billion in quarterly revenue and guided to about $108 billion next quarter, with fiscal 2028 growth near 70%. At a roughly $5 trillion valuation, the market needs more than another routine beat. Buy-side expectations reportedly sat as much as $1 billion above the guide, and some estimates were roughly $5 billion above consensus. Investors are focused on Rubin shipments, 2027 demand visibility, and evidence that supply constraints remain the main brake on revenue. The demand story is broadening. Non-hyperscale buyers, including sovereign AI programs, enterprises, industrial customers, startups, and other clouds, grew about 138% year over year, ahead of roughly 100% growth from hyperscalers. That diversification matters because it reduces dependence on a small group of giant customers. The stock entered earnings under pressure, down about 9% and lower in 8 of 9 sessions. Options implied a move around 5% to 5.5%, with $220 to $230 as near-term resistance and roughly $200 as a key support level. NVIDIA's lead remains strongest in AI training. Competition is building in inference, where Amazon, Google, and hyperscaler partners working with Broadcom are developing custom silicon. Designing a credible competitor can cost $300 million to $500 million, which keeps the barrier high while leaving NVIDIA's pricing power under scrutiny. Gross margin is the immediate proof point. Reported margins ran around 75%, while guidance moved to 74%, below the roughly 74.7% street expectation as memory, racks, and components get more expensive. Then there is the financing debate. Supplier commitments jumped from $119 billion to $279 billion in one quarter, largely to secure memory. NVIDIA is also reportedly backing customers through a financing initiative that includes neoclouds, sovereign AI buyers, and a reported $105 billion OpenAI commitment. Investors want cleaner disclosure on customer credit exposure, long-term leases, warrants, convertibles, and equity stakes. These structures can accelerate infrastructure deployment and diversify demand. They also tie NVIDIA more closely to the profitability of customers building the capacity. Chips are only one constraint. Estimates put U.S. AI demand near 70 gigawatts by 2028, against about 30 gigawatts of currently connectable data center capacity. Permitting, grid interconnection, water, construction, and local opposition could determine the pace of AI spending. About 60% of expected 2027 data centers reportedly have yet to break ground. That leaves the build-out exposed to financing delays, power shortages, and political resistance around new facilities. Memory is another strategic choke point. High-bandwidth memory and DRAM now shape model speed, compute capacity, and context window size increasingly through multi-year contracts. That supports NVIDIA demand while pressuring margins and elevating companies such as Micron across the AI infrastructure chain. Watch utilities, power producers, cooling suppliers, and grid technology alongside semiconductors. Vistra, NRG, NextEra, American Water, and Vertiv sit close to the physical constraints of the trade. Salesforce and Anthropic announced Cloudforce, connecting Claude to Salesforce data, Slack, applications, permissions, semantic layers, and agents. While Salesforce remains the governed system of record, Salesforce shares rose more than 10% on the announcement. The model is becoming clearer. AI assistants serve as the front door, while enterprise software supplies the secure data, workflow, governance, and accountability layer. Box is pursuing the same role for unstructured corporate data. Markets are rewarding visible AI revenue paths and punishing pricing pressure. Intuit fell after weak guidance as cheaper AI-powered tax tools challenged TurboTax. Zoom dropped despite strong enterprise growth because cautious profit guidance dominated the reaction. Cybersecurity and identity remain better positioned in this transition. CrowdStrike's retention and platform adoption support its AI security case, while Okta still has to prove it can grow through Microsoft bundling pressure. July PCE kept the inflation problem alive. Headline inflation ran 3.7% year over year, core PCE about 3.3%, and key services inflation near 3.9%. Real consumer spending rose only 0.1%, while the saving rate remained low. The 10-year Treasury yield near 4.65% to 4.80% is approaching a valuation danger zone. Barclays sees 5% as the level where the relationship between yields and equities becomes sharply more negative. That puts Jackson Hole and incoming Fed Chair Kevin Warsh's message at the center of the next macro move. Higher yields compress technology multiples, especially where AI positioning remains crowded and expectations are elevated. The broader market has already started rotating. NVIDIA fell about 5% over 3 months, while the S&P 500 gained roughly 3.5%, with Microsoft, Amazon, Alphabet, financials, healthcare, and energy carrying more of the advance. Iranian oil sanctions are increasingly a Washington-Beijing issue because China reportedly buys more than 90% of Iran's exports. At the same time, flows through the Strait of Hormuz remain well below normal. Qatari LNG shipments are reportedly halted, and Red Sea disruptions continue. Europe enters that backdrop with Dutch gas storage around 45% full, far below a typical roughly 73%. A cold winter constrained LNG flows, and further Hormuz disruption would raise the risk of higher energy prices and deeper economic stress. For the daily drawdown, the next AI move depends on guidance, grid capacity, financing discipline, and rates. Those are the numbers worth watching. This episode was generated by Podkey. Create your own at podkey.fm.